Hello, I'm Professor Alan Jakovich, and we're going to cover bond basics and how to compute the price of a bond. So let's jump right in. First of all, there's some things you should know before you just jump into a bond problem. Understand that a bond is a debt contract. Instead of the company borrowing money from a bank, it's borrowing money from the market, from a group of people out there who are looking for investments. So you're borrowing money from people. When you do that, you have to pay it back with interest. And that's a contract between you and whoever buys that bond from your company. So it's a type of annuity. And it looks like this diagram right here. Let's say we have a 5-year bond. Right here's 5 years. And it has a face value or par value of $1,000. What that means is we have to pay back. If we're the company, we will get money for the bond right up front because we borrowed that money and gave them an IOU. And we have to pay back interest called coupons here, 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 and here, annually, or if the problem says semi-annually, we'll pay twice a year, here and here, here and here, as you can see for yourself. But at the end of it, we pay back the face value, assuming that's $1,000, which it usually is. So what I'm showing you here by the color coding is that when the bond is originally approved for issue by the Securities and Exchange Commission, there is a certain market rate going on at the time. The going market rate is essentially what's going to be approved for your company's bonds. Let's say it's 6%. If it's 6%, you will have fixed coupon rates of 6% of par value, which is $60 in this case. That will not change no matter what happens to the market later. So when the Securities and Exchange Commission approves your bonds at a fixed rate, which is normal, you usually can't actually get around to finding a buyer or issuing it till at least 30 days later, and a lot of times you have a lot of bonds approved by the Securities and Exchange Commission, and so you're only going to issue some as you need to raise money, and you'll issue the others later. In the meantime, the market's not holding still. Rates go up, rates go down. So your fixed rate coupon payments will not change regardless of what's happening out here in the market. So if the market rate matches your coupon rate, then what the bond will sell for is the same as face value. These two will equal. You will get face value when you sell your bond if your coupons are 6% and the market is demanding, we want 6%. If you want my $1,000, you got to pay me 6%. If they match, good, you're going to get face value. But what happens when they don't match? Let's say the market rate, which changes all the time, now they want 8%. I demand 8%. If you want my $1,000, give me 8%. Your fixed rate coupons are 6%. They're going to look at your piddly little bond and say, that looks kind of shabby to me, I'm not interested, and the price will drop. You try to sell that bond, you're not going to get face value. You're going to get something less than $1,000. However, these are fixed. You still have to pay your coupon rate and that $1,000 at the end, regardless of what you get, right here for the price. So that's if the market demands more than your coupon rates are paying, your price will drop. And vice versa is true. If the market now is like money's everywhere, I demand 4%. That's what I want. I want 4% if I give you my $1,000. Guess what? They're going to look for an investment and they want to get at least 4% and they see yours and it's 6%. everybody's going to pile on. They're going to start bidding up the price of your bond, and you'll get more than $1,000 for your bond, but you still only have to pay that 6% and your $1,000. Those are fixed. So there are two rates that you compare to each other to determine the price of a bond. There's a couple other things about bond basics here. There's some rules of thumb. When you run across a problem that doesn't mention what the par value of a bond is, it's $1,000. Good to know, right? And if it doesn't mention how often the payments are going to be made, whether they're annual or semi-annual, assume semi-annual. So, because that's kind of normal for a bond, $1,000 semi-annual payments. And down here, I just sort of reinforce what we already talked about. Coupon rate versus market rate, which is in bonds, they like to call it the market yield or the yield to maturity. Bond terminology is just a little different, but it is rate in Excel. Rate equates to the yield to maturity. So let's work a bond price. So here we have your company issued a 10-year bond with a par value of $1,000 that pays 4% in annual payments. What's that look like? Well, here's 10 years and it's paying 4% in annual payments. What's that? 4% means 4% of par value. Now, how do you know that's not the market rate? Market rate is going to be called yield or market rate or market yield or yield to maturity. They're going to be using those terms for the market. This is a bond, see the word bond, that pays 4%. This 4% is tied to the bond. It is talking about the interest payments or the coupon payments. So it's a lot of terminology to get used to. So it's 4% of par value or face value, which is what you have to pay back at the end. Also, future value is $1,000. So that's that first line. You now know these fixed $40 annual payments and par value is $1,000. So these are all fixed, but the price is not. Then it says the current yield to maturity is 5%. Oh, yield to maturity is the market. The market wants 5%. Now, thinking back to what I just showed you, if the market is saying, give me 5%, and your bond is paying 4%, what's going to happen to the price of the bond? Are you going to get all of par value or face value? I don't think so. Your bond looks shabby to people who want 5% and you're giving 4%. Yours looks pretty nasty. So they're not going to give you $1,000. So you can expect that the price will be less than $1,000 before you even work the problem. So let's work this problem. Annual is this column right here. Let's put our numbers in. The present value is the price of the bond. And I'm putting a question mark there because that's what we're trying to solve for. The future value is par value. So that's negative $1,000. The company has to pay it back. We have to pay it back. It's an outflow. So now these three are in yellow, remember, because rate, number of periods, and payment must be on the same time frame, whatever the smallest time frame mentioned in the problem is, and it is annual payments. So rate is always given in annual terms, so it's already good to go at 4%. Number of periods, annual periods is 10. Number of not number of payments, just payment is 4%, and we don't put 4% there. It's got to be a dollar figure. Payment, whether it's an annuity or a bond, is always a dollar figure, not a percent. So 4% of $1,000 is $40, and it is an outflow from us, the company, so it's -40. And on bonds, its type will always be 0. So let's solve for this. We're going to put in whatever we're trying to solve for in Excel, and we're solving for present value. So we put equals sign, PV, because that's what we're solving for, and then open parenthesis, and it tells us what to put in next. Rate is bolded, so let me click on rate, hit comma, number of periods is bolded, hit that, comma, payment, comma, future value is next, comma, and type, and close parenthesis, and hit enter. And I got $1,000 because, oh dear, I made a mistake. Why? I put 4% for the rate. It's 5%. When I put that in, since I clicked on that cell and hit enter, it'll change my number. Boom. That was actually a pretty good demonstration that if the market rate equals the coupon rate, the price will equal the par value. You see how it popped up with 1,000 when I made this 4%? It was 1,000. So my mistake was actually educational. All right, so $922. As we said before, if the market wants more than we're offering, the price will drop. Now, what if the payments were semi-annual? So let's just do that. We're still solving for present value. Future value doesn't change. You see how it's in blue? It's fixed. So minus $1,000. But these three are in yellow. They must be converted to the smallest time period mentioned in the problem, which is semi-annual. So these three must be converted to semi-annual figures. So semi-annual will be half of 5%. It'll be 2.5%. Number of periods, instead of 10 annual periods, now we have two periods per year. So we have 20 6-month periods. And instead of paying $40 once a year, now we're going to pay $20 twice a year. So it'll be minus 20, and type will always be 0 on a bond. So let's solve for that. Oops. Equal sign, and we're still solving for PV, present value, or price of the bond, and then open parenthesis. It says rate, then number of periods, then then payment, comma, future value, and then type, and close my parenthesis, and $922.05. So the semi-annual periods actually made the price of the bond change a little bit. Not a whole lot, but enough. So that's how you compute the price of a bond. Good luck computing.